get the management on board to analyze these numbers. Chaitanya Zamalindagora is now joining us, who's the co-founder and executive director. Hi, Chaitanya. Thank you so much for joining us. Chaitanya, if I look at your EBITDA margins, your margins are up 195% on a year-on-year basis. They have expanded sharply this quarter. How much of this improvement is driven by operating leverage and festive-related efficiencies, and what margin range should investors build in sustainably?
Thanks for having me. Yes, you're right. The first reason is operating leverage kicking in, primarily because we are in a full stack company. We have manufacturing facilities, warehouses, etc. So these are projects that are multi-quarter long. So these are projects that would have started 3 quarters, 4 quarters, 5 quarters ago, and that has definitely kicked in. And in the central costs, we've also kept a tight rein on costs in the office, so that we are able to build in operating leverage. But the second part is obviously the festive related one, where OND is usually the Diwali quarter where growth is pretty good. So we encountered the same. So because of that, despite us giving promotional discounts, etc., during that period, we have shown a good utilization of our fixed assets, thus driving up the margins.
All right, Chaitanya, let's also talk about your revenue targets now. You are targeting mid to high teen revenue growth in FY26 now. Which levers you think will be the primary contributors now to achieving this?
There are a couple of major levers that we are going to be using. One is the continued expansion of the company-owned and company-operated stores. As of December 31st, 2025, we had about 137 active COCO stores. So that is a very big lever because customers can browse online, but given that we operate in mattress, furniture, and furnishing, a lot of the customers want to transact finally in our stores. So that also drives up the average order value as well as the repeat rate. So that's why we want to use that as the first lever. The second lever is obviously doubling down on brand building and marketing. Given that we are a digital native company, our experimentation is online. So we are able to try tons of experiments every quarter, scale up what works and kill what doesn't work, so that we are able to iterate constantly.
Right. Chaitanya, also the furniture and the furnishing categories grew significantly faster than the mattresses. How do you see this product mix evolving over the next 12 to 18 years?
You mean 12 to 15?
18 months, I beg your pardon.
Yeah, you're right. Given the smaller base effect and given the much larger total addressable market, furniture will continue to outpace mattress in terms of its growth. We are seeing that furniture continues to grow above 20%, while mattress continues to grow in the mid-teens. So over the next few quarters, again, we continue to expect the same trend. That means over 3-4 years, basically medium term, we might expect furniture to come close to mattress in terms of revenue contribution to the company.
All right, Chaitanya, now, with 65% of sales coming from own channels, do you also plan to further increase contributions, and how will this impact profitability and brand positioning? If you could just decode the roadmap.
Sure. You're absolutely right. As I mentioned earlier, customers want to browse everywhere, research everywhere, add it to their wish list, and then come to the store along with their family to make a transaction. So that is the reason the company-owned, company-operated stores where our sales staff, which is trained in our factories, trained in our warehouses, is able to really have a consultative view to what their requirements are. That drives up a lot of the conversion rate as well as increased average order value. But like you rightly guessed, the unit economics also are better there because we don't have to pay commissions or third-party costs that we have to pay on quick commerce or e-commerce marketplaces or even MBOs for that matter. So that is the reason that's very important for realizations also, not just from a revenue perspective. But the longer term impact is the fact that customers end up building a relationship with us. So nearly 35% of our revenue comes from repeat customers. So to help grow that number, having a touch point that is so personal is very important for us.
Chaitanya, so finally, a meaningful portion of the IPO proceed is earmarked for 117 new COCO stores and lease payments. What is the expected payback period and a store level EBITDA profile for these new outlets?
Payback profile varies by month, but it is much better than what you would see in a QSR or any other franchise model which is usually 24 to 36 months is what they take. Ours is definitely shorter than that as of now. But more importantly, the EBITDA is what we work very hard towards, because you have to remember that our stores only carry display inventory. So our stores are very asset light. That means a customer can come, browse, purchase, and go home. The product will be shipped directly to their home. So the stores don't carry too much inventory. They're very asset light. So because of that, the payback is also fast. And more importantly, EBITDA achievement is also within 6 to 8 months. So the store EBITDA currently is in the late teens, and we want to continue to increase that.
Absolutely. Chaitanya, let's talk about one of the most important expenses and spends, that's marketing spends. Now, they've been elevated due to a competitive intensity. By when and how quickly can spends, be normalized? What is the outlook out there?
Just to clarify, uh, the spends have not increased. Our anticipation is that since we operate in three categories: mattress, furniture, and furnishing. In the mattress category, there seems to be higher competitive intensity. So we foresee that in the medium term, we might have to increase it. But currently, our marketing spends are barely 5.5% of net sales. So it is very, very conservative, very optimally used with lots of experimentation. We don't throw money at the problem of marketing. But we believe that our historical averages, which have been about 8% of net revenue, we might have to take it up to that level if the competitive intensity remains at this current level.
Break. All right, Chaitanya, on that note, thank you so much for taking the time out and joining us on ET Now. We'll let you go on that note, and it's time for us to slip into a short break. Don't go anywhere after the break. We'll get you more on the other side. Stay tuned.